Hey, good morning, everyone. Marty Mazur here. It is Friday, the 7th of February, 2025, with your weekly update. Not going to spend too much time on the economy today. To be honest, I haven't scored our index yet. I will tell you that the jobs number this morning, or the jobs data, in the aggregate did not disappoint. Came in a little lower than expectations, but they were fine. I will say one fly in the ointment is that the work week, the number of hours worked, is essentially very low historically. Other than that, the unemployment rate came down a little bit. I did see yield spike on that news. 145,000 jobs versus like 170,000 estimated, and so on. So I'm going to dig into those weeds quite a bit over the weekend. And if there's anything else that I think worth reporting to you in terms of our thoughts on the economy, I'll follow back up either with a brief video or something written over the weekend. You may get it Monday morning if I do anything else for the blog. So for today, though, I thought I would just go through some of my notes. The reason I jumped on the video is because the market just took quite the dip, a very abrupt dip in the morning trading. Happened to be watching and couldn't really see what the news was, although I suspected what it would be, and that's exactly what it turned out to be. So I'll show you that on a daily chart here in a second, or I should say a one-day chart. But first, let's just talk about a few things that I have thought worthy of putting in our internal notes. The first being just this chart I threw in here yesterday is the level of cash as a percent of total assets held in Warren Buffett's portfolio. And I think we've talked about this before, but he is struggling to find value, speaks to the general setup, speaks very much about valuations, which is something we've been speaking about for quite some time. So the last time he had even close to this much cash as a percent of total assets in the last 30 some years was, just ahead of the great financial crisis. You can see where he started buying here as other people were panicking. So he gets nervous, as he says, when everyone else is greedy, and that's when you're going to see more cash. He gets greedy when everyone else is nervous. So that tends to be a time when you would see him begin to deploy his cash hoard. I say him, he and the number of managers and analysts who help him do his thing. Another interesting data point from this week is the results from, of all companies, Harley-Davidson. Not a large stock, as Bespoke points out here, but its report the other morning is economically relevant. It is your ultimate discretionary purchase. Missed its earnings per share estimate by 42%, revenues 10% below estimates, shipments were 7% below estimates. So folks are not spending money on motorcycles, nor are they spending money on those neat Polaris off-road vehicles. And I believe that things like boats and so forth, so those pure discretionary purchases are clearly losing some steam. I will say, though, that our assessment of the overall economy is better than it's been in quite a few months, but we do see these data points that are still telling us that we should not completely dismiss the notion that there could be a recession on our not too distant horizon. I featured this on the written blog earlier this week. I thought it'd be good to touch on it again, particularly in light of what's going on today. So as the chart here shows, there's been this interesting correlation here. The bottom one is the dollar, the white one is stocks, the golden color or orange one is gold, all moving in the same direction for the last few months. That's unusual. And I say here that something is going to give, not something has to give, something is going to give, make no mistake. And I offered up 4 different scenarios. If the dollar continues to rise on higher yields and political angst, and that would be characterized as tariffs right now, stocks will crack. Gold, despite the higher dollar, will maintain a bid due to angst and central bank buying, which I talk about in that opening paragraph. If the dollar continues to rise on yields spawned by a better economy and the tariff risk wanes, stocks, after a brief stint in all-time high territory, I think stocks would really rally on the waning geopolitical angst. they will ultimately succumb to record high valuations. They're too expensive right here relative to interest rates and rising inflation. So if interest rates are going to go up with inflation because the economy is doing well, that's problematic for stocks. If data and inflation soften and geopolitical angst wanes, so if the economy softens a bit, inflation comes down, dollar will come down, and stocks will continue to move higher into the horizon. Gold should hold up okay under those conditions due to the weaker dollar and lower yields. I'd be less bullish gold probably here versus the other scenarios after a decline initially in this scenario. If the data roll over into recession, the dollar will rise initially. The world runs to safety, the US dollar, treasuries in particular. Stocks are going to tank because the earnings estimates make no sense in a recession. Even though interest rates are going to go down, stocks are going to hate it. The transition would be data softens, stocks go up, data roll into recession, stocks utterly tank. Gold may take an initial hit. If we get an abrupt, deep sell-off in stocks, you're going to get margin calls. Then people are going to need to sell what they can get a good bid for. Typically, you'd see gold take a hit, but then it recovers relatively quickly as it is the ultimate safe haven. As the recession plays out, the dollar will ultimately fall as investors rotate to far better values in other places and as global interest rates come closer to parity. So in a global type recession, interest rates are going to all drop, and the U.S. interest rates on a relative basis, save for a few currencies or countries, have further to fall. They get closer to parity. Suddenly the interest rate differential doesn't favor the dollar so much, and the dollar comes down. The yen will be, I'm quite certain, the best performing currency in a global recession scenario. Okay, that, and then this is going to speak to what I'm going to show you here in a second about what the market's doing today. This is pre this latest election. This is post the election. Two different sources of the surveys. Here's the thing, folks. Voters do not care about this trade issue. That is among the lowest of their stated concerns. Inflation is their big concern. And again, as I said from the get-go, and as I was even, charting the first Trump presidency, that if they go hard on trade initially, market's not going to like it, and that's been clearly evident in the action over the last few weeks and this morning, as I'm going to show you. MRB, Macro Research Board, they did a nice piece on tariffs. I've been talking about protectionism for years, and I highlighted a few things. Equity risk. The U.S. market is expensive relative to most other markets. I think we pounded that point home enough. The high flyers in the U.S. market are also global companies, U.S.-listed global companies, some of which will be threatened by a trade war, and we're seeing that this morning. Indeed, during 2018, when the trade war heated up, economic risks escalated, earnings growth slowed, yada, yada, stock prices fell. Two different corrections in 2018, a 10% and 20% respectively. Equity prices are likely more pronounced drawdown, given that they now have considerably less valuation support. And that is the point I keep making, folks. Global equities would also suffer, although they have much greater valuation support. And it's another point I keep making. So really precarious times if we're going to stay on this trade war path, if you will. So here we are this morning. This is the S&P 500. It was hanging in there, pretty much around the flat line relative to yesterday. And then this is what I was talking about. All of a sudden, boom, we got the sell-off, tried to recover a little bit. You can see what's happening right now. The announcement was Trump tells his advisors to prepare reciprocal tariffs. I believe that was the term that was used, as soon as Friday. And I'm just quoting the news source, so I presume that's today or next Friday, let's say. It's going to be interesting, all the noise that we're going to hear over the weekend. So there's what the market is doing in reaction to that news. As of this delayed chart, it was down. The S&P was down 0.2%. Right now, it's down just a little bit less than that. The NASDAQ 100 is down 80 basis points. The Dow is down 200 points. It was down over 300. So we'll see. Who knows? Maybe we'll get a recovery. It does seem to be that the market is, I think, inspiring something different than the initial announcement portends, as we've seen with Mexico and with Canada here over the last week or two. The dollar, remember, the dollar is a problem, right? In this kind of scenario, look what the dollar did on the news, spiking big time. I've told you that a spiking dollar in this environment, it would be a headwind for stocks. And so, again, so this is a reaction to that comment from the president that get ready, there's more tariff news to come. A couple of weeks ago when I gave you my two scenarios for a 10% higher move over the next few months for U.S. stocks, and then the 4 bullet points that I just gave you, a continued sustainable move higher in the equity market demands something much, much less than was promised on the campaign trail around trade. And again, as I just showed you in the surveys, the consumer isn't really worried about that. The voter isn't. The voter is worried about other things like inflation. And at first blush, people associate tariffs with inflation. In fact, this morning's University of Michigan consumer survey, the one-year inflation expectations just utterly skyrocketed from like 3% to 4 point something. That's very unusual, and I'm certain it's all around the public's perception of what tariffs will do to the price of goods. Longer term, if indeed we entered into a protracted trade war, it will cause a recession and we will have disinflation amid the higher tariffs. But I understand where the initial reaction is coming from. Okay, let's just take a quick look at the technicals and then we'll wrap up. So here is that, just the daily chart. I think that's all we need to look at right now. This blue candle is today. You can see still trying to pierce those all-time highs. Losing the 50-day moving average one more time here might be a bad thing. So we'll see. You can see we've been playing with it, pounding against it. If that weakens to the point where we lose it with some momentum, stocks could go down quite a bit. The momentum indicators are suggesting that that's a serious risk right here. As for the NASDAQ 100, you can see it's been playing right on that support and resistance line. It's been more resistance than support. That 20-day moving average lines up right with the 50. Those things give way. That's double support right here. Probably will bounce off of that again if we continue to hit it. But eventually, bearish divergences, and it still is there despite peeking out of that sideways, suggests that we need to be aware of that risk here in the near term. The dollar index screamed higher Monday, coming off of the news that they were going to put the 25% tariffs on Mexico and Canada. Then, and the market was down, like the Dow was down like 700 points. That one comes to mind. But then they backed off of that. There were some concessions made, and they said, well, wait a month. And remember, I had a technical bear flag pattern here for the dollar. So we quickly came back into that. I don't know that this is still valid. We'll see if the dollar falls. It's going to need another 180 on the tariff news from today to continue its descent. Right here, you can see that's a up candle today. 10-year yields fulfilled that bear flag pattern right to a T. You know, it's funny how these technicals can work. And we're bouncing off of that right now. A rising yield is ultimately problematic for stocks. We did see a massive decline day before yesterday. This was bewildering to a lot of folks. The Treasury's quarterly refunding announcement, what they say they're going to do going forward versus what was anticipated, in and of itself would be bearish for the longer term yields, and this is the 10-year yield. Bullish for the price, so this is interest rates coming down. Scott Bessent, the new Treasury Secretary, said that's going to be their focus. That's going to be an interesting conversation as to what their plans are to bring that down, but their focus is not so much on the Fed lowering interest rates right here. They do seem to get it, and that is that you lower interest rates into an economy that's not rapidly descending, you're going to get what you get in the fall, what you got in the fall, and that is they cut interest rates by 50 basis points. Everybody thought that was great. And then mortgage rates promptly went up by over 100 basis points. And that was counterintuitive to a lot of people. I've been doing this for a very long time, and I had even suggested on the blog that a 50 basis point cut is probably going to be bearish for bonds and stocks because it's going to be viewed as inflationary. Right now, the powers that be seem to truly understand that. Pulling off a 10-year yield dropping just because you want to is going to be a tough lift if indeed you're going to do things to stimulate the economy. That's going to bring the 10-year yield higher, not lower. All this remains to be seen, and of course I'll keep you updated day by day as we go. And then lastly, gold, continuing this amazing run. Gold's been very good to us because it's a not small individual position in our portfolio. We broke out of these bearish divergences that worried me. A little overbought right here. Gold's going to have to correct a little bit from these levels, but today's news and geopolitical angst, as I've said, is on net positive for gold, despite the fact that it's also positive or bullish for the dollar. So I will stop rambling there. Like I said, I may or may not get back to you here on the blog over the weekend. Just all depends on our assessment of the latest news and whether I think there's something that I want you to know or want you to be thinking about. So thank you, folks, as always, for watching and listening. Appreciate you very much. Hope you have a wonderful weekend, and talk to you next week. Bye-bye.